we just saved a buyer about 2 percentage points in rate, and we closed the deal. We closed it in roughly 3 weeks, and the other lender that had the deal, they had it for 2 months. Hello, my name is Mike Florin, and I'm the owner of Low Cost Mortgage. Today's your weekly update for April 2nd, 2025. All right, so I want to talk about rates, rate trends, and also the fact that we just saved somebody 2% in rate and closed the deal in 3 weeks, where the other lender was going to take 4 months and 2.5 months in, and they still were not in underwriting. Okay, so let's get started. We'll go rates first, and then we'll talk about that scenario. All right, now, rates. I'm going to pop up 2 basic charts for us to look at. One is about a 15-year history of the T-bill, and I want to show you roughly where we are now versus where we were years ago. So if you notice, I'm going to circle on the chart. Right around 2007, 2008, the T-bill was at a certain position. Now, the T-bill is not directly correlated to interest rates, but it's close. It's a very easy visual representation. And for you as realtors, you should be monitoring the 10-year rate on I want to say, probably a 1 month or 2 month or maybe 3 month history. And if you do that, you're going to keep track of roughly what's trending in rates up and down. But let's look at this chart some more. 2000, 2007, 2008, roughly it's high, and then it comes back down through that long recovery that we had during the Obama administration. And then you start to see it move a little bit. But I want to go back to the most recent time, which is rates going up. Now I'm going to go ahead and circle this other area. This is where rates peaked. And if you notice from where they peaked a few years ago, we kind of have this slow movement downward. And that's through the Biden administration and currently through the Trump administration. So that is the generalistic trends. You see it go down through the pandemic. We'll circle that one real quick. So back up here. You got 2008, it's up, right? It's moving along, moving along. You got the pandemic. That's a big event. It goes down, stays down for probably too long. And then it starts to move back up again because they're chasing inflation. Now you got that peak, and now you see this kind of a lot of movement, but it hasn't crested that peak. And if you look at that big blob of data, it's actually somewhat downward trending. Now, we're going to look at a second chart. This second chart is going to be the last few weeks. So it's going to be a 3-month chart, most likely. I'll pop it up afterwards and show you. But everything's been trading in a range in the last 4 weeks or so. Now, if you see that trading within a range, but then last week it started to hit the high part of that, now it's hitting that low part of that. Now, that could be an overreaction of the expected tariffs. There's a lot of different reasons for that. But in essence, less demand on T-bills, and as we've talked about many, many times, the same money that's in the 10-year treasury is the same money that's in the hedges, which is the same money that's in the mortgage-backed securities. Now, it's not the same money, but generalistically speaking, money is going to be moving between those three. Now, not all the time, of course, not 100% of the time, but a good chunk of that time, you're going to see if the T-bill starts to go down, then that money might get pulled from the T-bill and it might go somewhere else, like mortgage-backed securities or somewhere else. The main point is people that are investing in this type of environment. These aren't the buyers, these aren't the mortgage companies, these are the investors that are investing in that return, the interest that they're going to get off of it. They want long-term return, and that's what they're looking for. And mortgages, historically, every 7 years, you would see that a mortgage is refinanced or so, or they sell their house, they go buy something else. But even though it's a 30-year note, most investors are not expecting it to last more than 7 years. The caveat to that is the really low rates we got during the pandemic. A lot of people have actually been selling those houses, and they've been refinancing those houses into higher rates, which is kind of weird. And I try to talk people out of it usually when it makes sense. It never makes sense to refi, usually. But sometimes it does, but usually not, out of the 2% rates, right? But anyways, with that being said, that money's being moved between those 3 different areas. And the big hedge funds, right, are going to be investing into long-term assets as well. So this is why if you see the 10-year go up, you see interest rates go up, mortgage rates go up because it's supply and demand of cash, down and down. Now that other piece for good rates, and we see the dip that's happening in this most recent chart, mortgage companies, and we're talking about the big entities, right? You're talking about Wells Fargo, Chase Manhattan, UWM, Rocket Mortgage. You're looking at a lot of these different companies. They're competing for deals. So as those companies compete, they start to lower their rates. And what we find is out of all the investors that we use, typically the same 4 or 5 investors are right about the top. But it's funny or interesting, not really funny, but definitely interesting how there'll be a mortgage company, they'll start calling us for business, and within 2 or 3 days, they're at the top of the list for about a week or two. Then they get their fill, and then they turn it back down again. And that's how bigger mortgage institutions or bigger finance companies tend to throttle their input of loans. And that is, if they need more loans, they're going to lower their rate. And if they need less loans because they're too busy, they're going to increase their rates. So that's how the bigger mortgage industry or the mortgage companies actually throttle their mortgage volume in or out or up or down, right? So if they want more input, lower the rates. If they want less input, raise the rates. And you'll see a lot of banks and credit unions do the same thing. If they're at capacity, they'll start to increase their rates, et cetera, et cetera. And that's one of the nice things that's being on the broker side. So we're brokers, right? And I've been direct, I've been a banker, and I've been a broker. Now here's the thing about direct lending. With direct lending, you work with just your direct secondary markets. That's it, just one company, that's all. When you work with a bank, you're working with one bank, the secondary market's in that bank, and that is all. With a broker, as long as we're set up correctly, which this company is, you're actually working with a dozen or 2 dozen or 50 or 100 or whatever that looks like. As long as your company is set up correctly, where you can handle most of that work internally, then what you've done is you've leveraged yourself out to several of these direct lenders and several of these banks. That way, whoever has the best pricing, you can just go straight there. Now, the loan officers that are stuck at an individual direct lending outlet or at an individual bank, they're at the mercy of the secondary market, and they're at the mercy of their internal systems. Because if management sees that their internal systems are lagging or basically producing loans slower, they're going to increase their rates. So that loan officer, for those few weeks of time that the rates are increased, they're not very competitive. But then when they need more deals, that bank, that direct lender will lower their rates for a few weeks or so to get a bunch of deals in, and then they're really busy and the rates are really good, and then a few weeks later, the rates are bad again. Well, we don't have that issue. Brokers don't have that issue. Why? Because when company A is really cheap, we're going to send loans over there as long as they're a good outlet for it. And then company B decides we want more of that action, and so we start sending loans over there. It's really cool. But when it's set up the right way, it's really cool, really works. If it's not set up the right way, it's a big dramatic failure. So luckily, we're set up the right way, which is why we have 5 stars on Google. Okay, so we're going to talk about a scenario. All right. We just saved a buyer about 2 percentage points in rate, and we closed the deal. We closed it in roughly 3 weeks, and the other lender that had the deal, they had it for 2 months. They couldn't get the deal closed. The person called me. I put them through the little pre-approval process, got the contract in, and started running with it. We had them closed in 3 weeks. The other lender still was not in underwriting. So they're 2.5 weeks in or 2.5 months in or so, and they're not in underwriting yet. And they told the borrower right when we started to kick it off, oh, it's going to be another 2 months until it's closed. Well, I'm not going to give you specifics about who it is, but I'm going to tell you specifics about the loan and why. At first, it didn't make sense to me, but when we were halfway through the loan process, it absolutely made sense to me. The original loan officer was completely incompetent. Now, I'm going to explain something. Realtors, please listen to this. This is going to be extremely important for your borrowers, okay? Now, if you have what's called mattress money, you have cash that's literally not in the bank, not sourceable. It is hidden. It's in a safe. It's whatever. It's cash. There's actually quite a few buyers that have cash. Now, there's a rule, and that rule is a seasoning rule. And that rule is simple. Any large deposit that goes into a bank account has to be sourced. And I'm oversimplifying it. Well, if you deposit 50 grand, 100 grand, 200 grand, whatever that is, $10,000, whatever that is, you have to source it. You have to show where it came from. Well, if it's cash that came from your safe or cash that you were literally storing under your mattress, which would probably be a pretty bad idea if there's a fire, you cannot source that. Cash cannot be sourced, so cash cannot be used. Well, if cash is in a bank account and you get 2 full bank statements, so let's just say it's deposited in January, and then you get a statement for February, and you don't see the large deposit, but you see that there's a large balance. We'll just use a round number, 100 grand. So the borrower puts 100 grand in their bank account in January, and then in February you pull a statement. It doesn't show the $100,000 deposit, but you get this 1 month statement that shows a $100,000 balance. Now, you have 1 month of that in February, you have another month of that in March. Guess what? You now have 2 bank statements that can be used to source the funds. Now the funds are there and they're sourced. And that's your trick. If you take all the cash, it could be $1 million. It doesn't matter what it is. You throw it into a bank account and you don't touch it. Don't withdraw from it. Don't pull money out and do it to an investment to bring it back and put it back in. We've seen that a lot of times, okay? If you need this money for closing a loan, you're going to put it into an account and it's going to sit there. Now, you're going to wait and you're going to get 2 full bank statements without any deposits in it. Guess what? Now the money is sourced properly in relation to mortgage guidelines and mortgage rules. Now you can use that money to buy a house. Now, let's talk about incompetence. The other loan officer that was on the deal, that we stole that deal from, that other loan officer at that other mortgage company was pretty new, and they're not very well experienced. They told the borrower to take this theoretical $100,000, it was more than that, but $100,000, and just every few weeks put in 20 or 30 grand. Well, it took that borrower about 2 months to put in the cash that they had, depositing 20 or 30 grand every 2 to 3 weeks or so until they had it all in. And that's why that other loan officer didn't submit it to underwriting, and that's why that other loan officer didn't do anything for 2 months, because they told the buyer to do the wrong thing. The guideline says it has to be in the account for 2 whole months and not see the deposit. They told them to drip the deposits in for 2 months. So if you're picking up what I'm putting down is that loan officer delayed that borrower for 2 months. Now, that loan officer probably figured it out. Probably someone from underwriting or processing told that loan officer, hey, now we got to source this. So now it has to sit there for 2 months. And that's where the other loan officer said, oh, we've had the file for 2 months, but we're not ready to go into underwriting for 2 more months. It's a seasoning problem. Now, we got around that because we know what we're doing. We understand the rules and regulations. Now, I bring this up a lot, but there are roughly, there's actually more than this, but we're going to say there's roughly 6,000 pages of rules and regulations. And inside of those rules and regulations, the logic is if this, then that, and if this, then that, and if this and this, then that, but if not, then this, and if not, then that. That's 6,000 pages of that type of logic and bullet points, okay? Now, if the loan officer can actually read and understand the 6,000 or so pages, it's impossible to memorize all of it, and the rules are constantly changing or in flux in some capacity, that's fine. But the problem is a lot of loan officers, they get their license and they stop reading. That's my biggest complaint in this industry. Loan officers get their license and say, woohoo, I'm gonna go make money, let's go slam some deals, and they quit reading. And the rules, those 6,000 pages, it's a lot of information. That is where we make our money, is knowing the rules and how to apply them. So in summary, other loan officer incompetent, lost the deal to us. We were 2 percentage points cheaper in rate. We got the deal closed in 3 weeks. The other place was 2 percentage points more expensive, and it was going to take them over 4 months to close the loan. Not because that company is a bad company, it's an expensive company, but not because it's a bad company, it's because that loan officer is incompetent and gave bad advice. Now, if you want good advice and you want a really good deal, call Low Cost Mortgage. If you want bad advice and you want a bad deal, call anyone else. It really doesn't matter. So anyways, my name is Mike Florin, owner of Low Cost Mortgage. Have a great day. Hopefully you guys get out there and make lots of money selling real estate. And you buyers, I hope you get out there and shop and compare. Always compare lenders. Usually we're the cheapest. Sometimes we're not. And I have to legally say that. Sometimes we're not. It's pretty rare though. But anyways, have a great day. I'll talk to you later.